Good afternoon, everybody. We're ready for our first lecture. Give me a second to get the PowerPoint going. Hold on, please. Okay, we're just about there. Can somebody tell me if they can see the PowerPoint, please?
Yes, we can.
Okay, thank you, Miguel. Thank you. All right, welcome to our first class. We'll be doing this hopefully every twice a week and get you to be experts in financial accounting. All right, introduction to financial statements. 3 learning objectives in this chapter, it looks like. Identify the forms of business organization and the uses of the accounting information. So let's see what they have for us. Forms of business organization. In this country, I guess all over the world, you have sole proprietorships, partnerships, and corporations. Sole proprietorship, that's one person setting up his own business all by himself, by herself, with her own money. It's easy to establish and you control everything about it. And there's a tax advantage that corporations don't have. The issue with a sole proprietorship, though, is this. If you invested $10,000 in your business and after the first year, say, you lost $100,000, you would be personally responsible for that extra $90,000. So it's a high risk, high reward type of environment, a sole proprietorship. Sole proprietorships are the most common form of business in the United States. Partnerships are similar. You share your skills, you and your partner. You might share the profits equally or in some agreed upon proportion. Again, you've got that little tax advantage over a corporation. The problem with the partnership is the same as sole proprietorship, though. You can be personally responsible for millions and millions of dollars of losses, even though you only put $100, say, into the company. So again, high risk, high reward. And corporations, well, those are easy. These are easy to become an owner. All you have to do is call up a stockbroker and tell them buy 100 shares of Coca-Cola. Corporations, easy to transfer ownership. You just sell it with a click of a computer mouse. And it's easier to raise money if you're a corporation. They can always issue stock to the public, or they can prepare a bond issue. Also, in a corporation, if things go south and the company's bankrupt, nobody is personally responsible, unlike sole proprietorship and a partnership. Of course, if there's fraud involved, that's a different story. Okay. And the tax problem with a corporation, though, is they pay both the income tax and the tax on dividends. So there's sort of a double tax on a corporation that you don't see with a sole proprietorship or a partnership. Who uses the data? Who uses this financial data? Who's interested in it? Well, people who work for the company are interested. You know, the financing people, the treasury, they want to make sure there's enough money to grow. Marketing wants to know what to charge for their products. Human resources wants to know who they need to hire, what kind of people, and what salaries are available. And certainly management, they're measuring the company. You as an average employee might have a very good interest in the financial statements. You might be a salesperson and get a bonus based on a certain threshold. In other words, if you sell more than $100 worth of product, you get a bonus. You want to make sure that that's what you're seeing in the financial statements. External users, people who are not associated with the company are super interested. Investors, is General Electric earning satisfactory income? Sad to say, no. General Electric is a company that's in big trouble. Sad to say, it's an American icon. But investors, no one's going to invest in your company unless you have good audited financial statements. Same thing with creditors. A creditor is a lender. No one is going to loan you money if you don't have decent financial statements. Okay. Investors, how does Disney compare in size with Time Warner? Investors are always comparing companies in the same sector. Which one should you buy? And here they're just talking about working knowledge is. Here, I'm not going to go into this too much. They're just talking about the different levels of work organizations and how they benefit from the accounting. Ethics. Whoa, let's talk ethics. There have been some horrifying financial scandals about 20 years ago. Enron, I don't know if any of you have ever heard of Enron, the largest bankruptcy in American corporate history. It was a company that traded energy, and it turned out that most of what they were reporting was a fraud. It was a fraud. They were pumping up the stock price and cashing out. The company was not making money at all in their last number of years. It was such a big scandal, it put the most prestigious and largest accounting firm out of business, Arthur Andersen, because they got caught up in the scandal. So Congress passed an act called the Sarbanes-Oxley Act. Paul Sarbanes from Minnesota, I believe, and James Oxley from Maryland, two politicians in Washington. And this put all kinds of restraints now on companies. Specifically, management for the first time has to sign off that they understand their own financial statements. Believe it or not, that was not the case. And they're talking about an ethical dilemma. We all have our personal ethics. Hopefully they're high enough to avoid these pitfalls. Some companies will give you your ethics. They'll tell you what's acceptable, what's not in many situations. But identify the people involved in a business decision, persons who may be harmed or benefited. What are the responsibilities of these people? Select the most ethical alternative, okay? Considering all the consequences. Some situations involve more than one right solution. You have to analyze. You're going to do a lot of this in the world of accounting. Here, I felt the pressure, would you? That's what some of the employees of the now defunct law firm of Dewey and LaBeouf indicated when they helped overstate revenue and used accounting tricks to hide losses. I was instructed by the CFO to create invoices knowing they would not be sent to clients. When I created these invoices, I knew it was wrong, knew it was inappropriate. So there's peer pressure that can be put on you. I felt the pressure, would you? I intentionally gave the auditors incorrect information. Terrible, terrible. So getting back to the organization forms again, easier to raise funds, corporation, simple to establish, sole proprietorships and partnerships, no personal legal liability, corporation. The tax advantages go to the sole proprietorship and partnerships, and corporations easy to sell your stock and change ownership. Okay, so that's probably worth some multiple choice questions on any upcoming test. Which of the following did not result from Sarbanes-Oxley? Well, let's talk about what it did do. Management now must certify the accuracy. There are now real penalties for fraud, really strong penalties, and the auditors were given more power to look deeper into the financial statements. 3 types of business activity we're going to talk about, huh? 3 types of activity: financing, investing, and operating. And the accounting system keeps track of each of these items, okay? Let's start with financing. Financing is borrowing. That's all financing is. Financing is raising money by borrowing or issuing stock to the public. Financing, it has nothing to do with the operation of the company. It is just a means of raising cash. You can do it with a stock issue or a bond issue, okay? When you borrow money, you're setting up liabilities. They're called liabilities, notes payable, bonds payable. So that's borrowing. Financing is also issuing stock to the public. You issue common stock and then you're going to pay them dividends. That's called financing. It's independent of your operation. Investing would be as follows. Investing would be you bought a stock or a security of some kind in another company. Microsoft has a lot of cash lying around these days. Bill Gates, he can go out and buy 1 billion shares of Coca-Cola if he wanted to. That would be an example of an investment. But more commonly, when we're talking investing, we're talking buying a huge piece of equipment, a vehicle, that's an investment, a building, that's an investment, a large machine, investment. Now, operating is where you want to see the good results. You want to see the good cash flow coming from operations. Operating activities are those that reflect what the company does for a living. Coca-Cola, my favorite stock. Coca-Cola bottles and ships and markets soda. Their operating expenses in that, their operationers, they sell the soda, they buy the raw materials, they pay their vendors, they pay their employees, they collect money from customers. They do all the normal things associated with coming up with the operating amount, okay? That is just the core business of what they're doing. Revenues are generated. They sell their product. Inventory is an asset. Accounts receivable, the right to receive money from a customer as a result of a sale. Operating activities include those expenses I just talked a little bit about. The cost of goods sold, your selling expenses, the liabilities. Classify each item as an asset, liability, common stock, revenue, or expense. Well, I think they're getting ahead of us with this, wouldn't you say? But let's go through it. They're giving us examples. The cost to rent property, that's called an expense, an expense. An asset is anything worth owning that the company has, anything of value that the company owns. Cash is a wonderful asset. Accounts receivable. A liability is a debt. A liability is an IOU. You can have accounts payable, which are the amounts of money you owe to your trade vendors. Notes payable, you might have borrowed money, you owe it on a note. You issue shares, that's common stock. Money you get from selling your product is revenues, and the amounts that you owe to people could be liabilities. Let's look at the 4 financial statements. Now we get to do something, huh? There are 4 statements. 3 of them we're going to emphasize. Income statement, retained earnings statement, and a balance sheet, and a cash statement of cash flows. They must be done in this order, and that's important to understand. You must start with the income statement and then do the retained earnings and then do the balance sheet, okay? So let's take a peek. Here is a typical simple income statement. You had revenues of $10,600, and then they list all the expenses below, and those expenses total $7,740, leaving you with a net income of $2,860. I think we can follow that logically, right? Income statement. You must do the income statement first because we have to get that net income number to bring it over to the next statement, which is what we're going to call the retained earnings statement. Retained earnings is a component of the company's equity, So we take when we do this report here, you want to bide your time. You know that expression, bide your time? BIDE, beginning balance, retained earnings, income, add your net income, subtract dividends to get the ending. That's all you do there. You take the beginning balance of retained earnings or that component of equity, You add the net income and subtract the dividends. Now, the retained earnings is zero because this was a brand new company. The first month of the year, though, made a profit of $2,860, and that's sitting up there in that portion of the equity. But they also chose to give out $500 in dividends, so that was very nice of them. Okay. And they're showing you the relationship of the statements. Here's why you have to do the income statement first, because you need that net income number to bring it over to the retained earnings statement. Net income is needed to determine the ending balance in retained earnings. Now that we have the ending balance in retained earnings, we can turn to the balance sheet. And the balance sheet is your accounting equation. Assets equal liabilities plus equity, which I hope we get into in a couple of slides here. Assets are listed and totaled, and so are the liabilities and stockholders' equity accounts. And these two numbers must be the same. Total assets, 21,910, equal total liabilities and total equity. And the reason we had to do the retained earnings statement second is we're going to take this number here, that 2350, and we're going to bring it over to 2360 and bring it over to the financial statement. Okay. Now we're looking at our formula. Assets equals liabilities plus equity, huh? Equity could also be called capital, net worth. So this is a snapshot in time of everything that the company has in assets and liabilities, okay? And they're showing you the balance sheet, getting their number from the retained earnings statement. They're repeating, it looks like they're repeating that slide. Let's just take a quick peek at the statement of cash flows. You have an entire chapter devoted to statement of cash flows later on in the class, but let's just understand the basics right now, okay? We are interested in knowing what the cash was at the beginning of the period and what the cash was at the end of the period. In this example here, there was no cash because it's a brand new business, but at the end, it had $15,200. We want to know how much of that was due to operating, how much was due to financing, and how much was due to investing. And what the cash flow statement does is break it out. And I'm not going to go into any real detail here, but the cash flow by operations was $5,700. They spent money, they had cash outflows. That's when you see brackets, it usually means a negative number. So they spent more on investing than they brought in. And they really borrowed money. Look at that. They borrowed $14,500. So if you're reporting this to the boss would say, okay, we had an increase of $15,700 in cash. How much of that did we generate from selling soda? And the answer is $5,700. The rest of it was borrowed. So that's just a quick look at the cash flow statement. It analyzes the operating, investing, and financing cash flows. What the cash flow statement does, it tells us where did the cash come from, where did it go, and what was the change from the prior period. Needless to say, cash flow statements are very important to look at. Some people will look at the cash flow statements before they even look at your financials. A lot of companies show profits, but a terrible cash flow statement. And you really have to be careful with a company like that. If a company is making money, they should not have a real awful looking negative cash flow situation. Net income will result during a time period when revenues exceed expenses. That's net income, revenues minus expenses. Which of the following is prepared in a specific period of time? That's going to be the balance sheet. And let me talk about this a little bit because this is important. When you have a header going on top of your statements, you're always going to start the Johnson Company, and then you say balance sheet. With a balance sheet, you must say as of December 31st or at December 31st, or just put down December 31st, 2020, whatever the year is, because the balance sheet is a snapshot in time. The other two statements are more of a video. Sales have been going up every day, up, 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 expenses going up. There, you don't use a specific date, you say for the month of. It seems like a small nitpick, but understanding that little point will help you understand these statements a little better. People, planet, and profit. Oh my goodness. We'll skip that. They're asking us to prepare an income statement. Now, I'm not going to make you pull out a piece of paper and do this right now, but let's go through it. Let's see if they give us a solution. That would be nice, huh? Okay. Looks like they gave us a solution, so that'll help. What is the statement we do first? The income statement, right? The income statement. And that's going to start with your revenue. So what we're going to say to ourselves is our revenue is 17,000. Now we must find all the expenses. And I'll give you a hint. The expenses will have the word expense in them, okay? So we have rent expense, insurance expense, supplies expense. I don't think I missed any. So 17,000 minus 9, minus 4, and minus 200. There's our income statement. Now we want to do the statement of equity. The statement of equity. I'm just making sure they're giving us the solutions ahead of time. So now we do our equity statement. We know we had 0 to begin with, and we have to come up with the statement of equity. You notice retained earnings has a question mark. So let's see what we're talking about. We're going to take the beginning equity, which is 0, and what do we add to it? We add to it the net income that we just calculated here, $6,800. And we're going to subtract any dividends, and I see dividends of 600. So it's 0 plus the 6,800 minus the 600. There's our retained earnings. Retained earnings is a component of stockholders' equity. It's where all the net income accumulates from month to month, year to year. Okay. Dividends, those are nice little benefits to people who own the stock. They sometimes collect dividends, and that reduces the net equity, your net worth. Dividends are not an expense. It's a reduction in equity. Well, now they want us to do a balance sheet. This is super easy because all you do with the balance sheet is copy all of the assets and liabilities over and put in the new retained earnings number, and you're done. So let's see what we have here. Assets. I see cash. I see accounts receivable. I see equipment. I see supplies. Those should be our assets. And there are our assets. Cash, accounts receivable, supplies, equipment. Let's look at our liabilities. Liabilities. Ooh, notes payable, 5,000. This company doesn't have any accounts payable. What kind of a company is this? So it looks like they have, where's accounts payable? Oh, there it is. I see it. Accounts payable and notes payable, $2,000 and $5,000. And notice that the total assets equal the total liabilities plus equity. This is your accounting equation done to a fine turn, okay? Companies issue annual reports, and these reports have financial statements in them, but they have a lot more than the financial statements. They have all descriptions of how the company did, what their kind of what is in the future maybe, and they include a lot of ancillary financial data. You have the financial statements, but they're going to have notes to them, and those notes are very, very formal. And people who look at statements look at those notes to glean more information. So in an annual report, you'll have the management discussion, and they'll talk about what's going on and how it went. And the management will highlight the favorable or unfavorable. It says management must highlight. They don't have to highlight anything in the annual report, but that's what they will do. They'll say, here's what went good, here's what went bad. Identify the significant events and uncertainties. We'll skip that. Notes to the financial statement. They clarify the financial statements, provide additional detail. They're essential to understanding. Here's a note from Columbia Sportswear. And let me just read this. We record wholesale, distributor, e-commerce, and licensed product revenues when title passes and the risk and rewards of ownership have passed to the customer. Title generally passes upon shipment or upon by receipt to the customer, depending on the terms of sale with the customer. Retail store revenues are recorded at the time of sale. So what they're telling you there is sometimes they ship their product on credit terms where the title to the product changes immediately upon the sale. Other times they sell the product, but they still own it until the customer receives it. And they have retail stores. So naturally, everything is recorded at time of sale. That's the type of thing investors might be interested in. The auditor's report. The auditor's report. The auditor comes in every year, the CPAs, and they're going to go through your financial statements with a fine-tooth comb, and they're going to issue an opinion. And hopefully it's a positive, or what they call an unqualified opinion. And when I was taking the CPA exam many years ago, we were told we should memorize this. They've changed it a little bit. And they go on to say, in our opinion, such financial statements prevent fairly in all material expense the financial position of Columbia Sportswear Company. And then you skip down and they'll say, also, in our opinion, such financial statement schedules, when considered in relation to the basic accounting financial statements taken as a whole, present fairly in all respects the information set forth. Now, does that mean that the financial statements are correct? Not really, because the auditor is saying this. The auditor is saying, here is the information you provided to me. Here is my best attempt to verify that it is correct. If there's fraud involved, the auditor may or may not uncover it. But all the auditor is saying is, I checked out the numbers that you gave me, and they make sense based on my normal procedures and policies for proving such things. Components of annual reports. What do we have? We have the notes, the auditor's report, other explanations. MD&A, I'm not even sure what that is. Ability to fund. Right, they stumped Professor Bob on that one, MD&A. I'll have to look what that is. Description of results of operations, and of course, the auditor's report. International accounting. I am not going to go into international accounting at all. We're not going to cover that. International accounting standards are different than US GAAP. So let's not go into that. Other than, I'll ask you to just read through it. Include this in your summary notes, though. Concentrating, I think, on the differences between American GAAP, American accounting, and the European standard. There's some differences. So let's write up what those differences might be, okay? Otherwise, we're not going to do anything with the IFRS. And guess what? We have finished, wow, that was only a half hour. We have finished our first lecture. Anybody have questions? Anything they want to talk about? Anybody want to show their face? Is everybody hiding? Are you there, Hunter? Hunter's hiding. Yeah. Okay, no question. You're okay, Teddy?
Yeah, just thought I'd come take notes. Sorry for being late.
Oh, that's okay. That's okay. So anyway, we got through it. And if it's okay with everybody, I'll say that this was our first lecture. It was a quick one. Others will take a little more time than this, but we'll typically be done 45 minutes roughly as an average, okay? So I'm going to close it up. Keep in mind that in a couple hours, this will be on my YouTube channel, the Bob Spagula YouTube channel. And it will also be in Canvas. Cornelia will do that in a couple hours once we rack this thing up, okay? All right, well, you take care, everybody. We'll see you later. Bye-bye, Teddy.
Thank you.
Thank you.
Bye-bye.
Thank you. Take care.
Good to see you all. Bye-bye.